Hello everyone, let's discuss a topic that is rapidly moving from optional to essential in modern corporate finance: how corporates can effectively and responsibly invest in financial markets. Traditionally, companies have focused their capital on what they know best, their core business. Whether that's manufacturing products, delivering services, or building technology, capital allocation has largely been inward-looking. Treasury functions in many organizations have been conservative by design, focused on safeguarding cash, ensuring liquidity, and minimizing risk. But the world has changed. Today's economic environment is shaped by persistent inflation, volatile interest rates, geographical uncertainty, and increasingly interconnected global markets. In this context, simply holding large amounts of idle cash is no longer a neutral decision. It is an active drag on value. So the conversation has shifted. The question is no longer, should corporates invest in financial markets? The question is, how can they do it intelligently, safely, and strategically? Let's begin by unpacking why this matters. At its core, corporate investment in financial markets is about capital efficiency. Every dollar sitting idle on a balance sheet has an opportunity cost. When inflation rises, the real value of that cash declines over time. Meanwhile, well-structured financial investments, whether in fixed income, equities, or diversified funds, offer the potential to generate returns, even after accounting for risk. But this isn't just about earning extra income. It's about strengthening the entire financial foundation of the company. By investing in financial markets, corporates can enhance returns on surplus cash, diversify income streams beyond core operations, hedge against specific risks such as currency fluctuations or commodity prices, improve overall balance sheet performance, and increase shareholder value over the long term. Think of it this way: if your operating business is one engine of growth, financial investments can serve as a second complementary engine. However, with opportunity comes responsibility. Unlike individual investors, corporates operate under stricter constraints. Decisions must align with fiduciary duties, regulatory requirements, and internal governance standards. Mistakes can have far-reaching consequences, not just financially, but reputationally. That's why success in financial markets begins with a clear and disciplined framework. The first and most important pillar is defining investment objectives. Before allocating a single dollar, a company must ask, what are we trying to achieve? Different objectives lead to different strategies. For example, if the goal is capital preservation, the focus should be on low-risk instruments such as government bonds or money market funds. If the goal is income generation, investment-grade corporate bonds or dividend-paying equities may be appropriate. If the goal is long-term growth, equities and alternative assets may play a larger role. If the goal is risk hedging, derivatives or specific asset exposures may be used strategically. Clarity here is essential because it prevents reactive decision-making without defined objectives. Investment strategies can drift, especially during periods of market volatility. Let's take a practical example. Imagine a logistics company with significant exposure to fuel costs. Instead of viewing financial markets purely as a return-generating tool, the company could use them to hedge against oil price fluctuations. In doing so, it stabilizes operating costs while also engaging in market activity. This brings us to the second pillar, risk management. Risk is not something to be avoided entirely. It is something to be understood, measured, and controlled. One of the most effective ways to manage risk is through diversification. By spreading investments across asset classes, industries, and geographic regions, corporates can reduce their exposure to any single point of failure. For instance, a well-diversified corporate portfolio might include government securities for stability, corporate bonds for income, equities for growth, international assets for geographic diversification, alternative investments for additional risk-return balance. But diversification alone is not enough. Corporates must also define risk limits. These might include maximum allocation to equities, minimum credit rating for bond investments, acceptable levels of portfolio volatility, and maximum drawdown thresholds. These limits act as guardrails, ensuring that investment activities remain aligned with the company's overall risk appetite. Another key component is stress testing. What happens if interest rates rise sharply? What if equity markets decline by 20%? What if there is a liquidity crunch? By modeling these scenarios in advance, corporates can better prepare for adverse conditions and avoid being forced into unfavorable decisions during periods of stress. The third pillar is liquidity management. This is where many corporate investment strategies either succeed or fail. Unlike institutional investors with long time horizons, corporates must balance investment returns with operational needs. Payroll, supplier payments, debt obligations, and unexpected expenses all require readily available cash. To address this, many organizations adopt a tiered investment structure. The first tier is the liquidity bucket, funds that must be immediately accessible. These are typically invested in cash equivalents or ultra short-term instruments. The second tier is the operational bucket, funds needed in the medium term. These can be invested in slightly longer duration, low-risk instruments that offer better returns. The third tier is the strategic bucket, surplus capital that can be invested for the long term. This is where corporates can take on more risk in pursuit of higher returns. This structured approach ensures that investments support rather than hinder the company's day-to-day operations. Now, let's talk about governance. A strong governance framework is the backbone of any successful corporate investment program. This typically includes a clearly defined investment policy statement, an investment committee responsible for oversight, defined roles and responsibilities, approval processes for different types of investments, and regular reporting and performance reviews. Governance ensures accountability. It also creates consistency, so decisions are based on strategy rather than short-term market emotions. In addition to internal governance, many corporates benefit from external expertise. Asset managers, financial advisors, and investment consultants bring specialized knowledge, market insights, and analytical capabilities. They can help design portfolios, identify opportunities, and manage risk more effectively. For example, during periods of market volatility, an experienced asset manager may rebalance a portfolio, reducing a risk exposure to overvalued assets and increasing allocation to undervalued ones. This disciplined approach can significantly improve long-term outcomes. Technology is also transforming how corporates invest. Modern platforms provide real-time data on portfolio performance, risk exposure, and market conditions. Advanced analytics enable better forecasting and scenario analysis. Automation improves efficiency and reduces operational risk. This shift toward data-driven decision-making allows corporates to respond more quickly and confidently in dynamic markets. However, even with the best tools and strategies, success ultimately depends on mindset. Corporate investing should not be viewed as speculative or opportunistic. It is not about chasing the latest trend or trying to outperform the market in the short term. Instead, it should be approached as a disciplined extension of financial management. The goal is to preserve capital, generate consistent risk-adjusted returns, and support long-term strategic objectives. Let's revisit a more detailed example to bring all of this together. Consider a mid-sized technology company with 100 million in surplus cash. Instead of leaving this entirely in low-yield deposits, the company develops a structured investment strategy. 30 million is allocated to the liquidity bucket, invested in money market funds and short-term government securities. 40 million is placed in high-quality corporate bonds with varying maturities to generate stable income. 20 million is invested in diversified global equity funds to capture long-term growth. And 10 million is allocated to alternative investments such as infrastructure or private credit to enhance diversification. The company also sets clear risk limits, conducts quarterly reviews, and works with an external asset manager to monitor performance. Over time, this approach not only generates higher returns, but also improves financial stability and resilience. Of course, no discussion of financial markets would be complete without acknowledging the challenges. Markets can be unpredictable. Economic conditions can shift rapidly. Geopolitical events can create sudden volatility. This is why adaptability is critical. Corporate investment strategies should not be static. They should evolve in response to changing conditions, new information, and shifting business priorities. At the same time, it's important to avoid overreacting to short-term noise. Discipline and consistency are key. Another important consideration is regulatory compliance. Corporates must ensure that all investment activities adhere to applicable laws, accounting standards, and internal policies. Transparency is essential, particularly for publicly listed companies. Clear reporting not only supports compliance, but also builds trust with stakeholders. So, where should a company begin? The journey starts with a few practical steps. Assess current cash positions and future cash flow needs. Define investment objectives and risk tolerance. Develop a formal investment policy. Build the right internal and external team. Start with a conservative allocation and scale gradually. Most importantly, take a long-term perspective. Successful investing is not about timing the market perfectly. It is about consistency, discipline, and alignment with strategic goals. In closing, financial markets offer corporates a powerful opportunity, not just to generate returns, but to strengthen resilience, enhance flexibility, and create long-term value. When approached thoughtfully, corporate investing transforms treasury from a passive function into a strategic advantage. It becomes not just about managing money, but about making money work smarter for the organization. And in today's complex and competitive environment, that can make all the difference.